Creating the entity. In designing life insurance policies, the beginning point is the work of actuaries, the engineers of the whole process. They are working with a mortality table that is constructed from data on 10 million selected lives, people that have been through a selection process, not the person off the street. The purpose of the selection process is to prevent adverse selection against the company. That is, to call out those persons who are facing predictable death in the near future. It would not be a good thing for all the people insured to include persons that have a terminal illness, that are contemplating suicide, etc. Cancer patients and people with heart disease fall in the same category, and they are working with a theoretical lifespan of 100 years. The graphical illustration of the 1958 Commissioner's Standard Ordinary Mortality Table is illustrated here. There have been later editions of mortality tables, but it doesn't matter all that much when the tables were constructed, because the final result of the situation is dependent on the earnings of the money invested by the company, the current mortality experience of the company, and the expense of operating the company. All they need is a field of data from which to begin calculations. If mortality experience is better than that indicated by the mortality table, then it will reflect that fact by better dividends distributed to the policyholders. In fact, the substantial increase in dividends paid by companies can be attributed mostly to better mortality experience in the past several decades. Note that only 100 out of the original 1,000 have died by age 45, and out of those remaining 75% are still alive at age 65. Can you guess what has happened to life expectancy since 1958? Yes, there has been a significant increase in longevity. By the way, do you know where all this business of retirement at age 65 came from? Franklin D. Roosevelt got it from Bismarck in Germany several years earlier. The whole idea was to get these old folks out of the workforce in order to provide jobs for the younger generation, as if there are only so many jobs around, a socialist mental hang-up that has no validity at all. From all that, I can determine life expectancy for males in America in 1937 was 61 years old. Now the figure is in the mid-70s, but we're still using age 65 for retirement purposes. The coming debacle of Social Security is the natural result of operating from a faulty premise. It is not going to work. There is no legitimate reason for using such fallacious thinking to plan your life. I once read that John Templeton, creator of the Templeton Fund, who retired at age 80 and is now doing only charitable work and working harder than ever, made the observation that all should plan on working to at least age 70 before considering retirement. The most productive years are being wasted. Study the mortality charts and notice where all the dying takes place. Out of the 900 alive at age 45, 75% of them die past age 65. Of course, the situation is much more accentuated toward later deaths now, but in the everyday conversations about the need for life insurance, it is all centered on the period of age 21 to age 65. Not many people die during this period. In creating plans of purchasing life insurance, all calculations by the rate makers begin with the cost in a single sum of providing a plan of insurance that would cover one for the whole of life. It is called single premium life insurance. The insured plunks down the single sum and insurance is guaranteed for the rest of his life. It is possible to buy life insurance this way, but it is not a common occurrence. The diagram on page 38 is a continuum that depicts all the different purchase plans. On the left end of the scale is single premium insurance. On the extreme right is term insurance. In this plan, the insured is simply renting the single premium insurance for a limited period of time. When life insurance began over 200 years ago, it was all term insurance. It paid a death benefit if the insured died during the given time frame. So the insured persons paid ever-increasing premiums, because each year they lived, it was more probable that they would die in the current year, and finally quit because the premiums became prohibitive in a few years. Later, they died. Perceptive people noticed that this was not like other forms of insurance. They buy fire insurance, and it pays if a fire occurred during the period covered. They buy accident insurance, and it pays a benefit if an accident occurred during the period covered. There is a very strong probability that neither of the above would ever occur. But death for a person is not an if, it is a when. Responding to pressures from the marketplace, life insurance companies created a plan for purchasing the single premium policy with a payment period that began with the current age of the insured and extended to the theoretical lifespan of 100 years. They called the plan Ordinary Life. I submit that this was a gross misnomer. When you classify something, it is based on its major characteristics. The animal they created had much more in common with banking than it did with life insurance. When you look at the proportions of the whole activity, it is obvious that the banking qualities became much greater than the death benefit quality of a policy. A better name would have been a banking system with a death benefit thrown in for good measure. The whole idea of the infinite banking concept started with the realization that there is a huge amount of nonsense going on in the marketplace because of the misclassification of things. This is not new, nor is it unique to the financial world. For instance, take the case of the common potato. In the late 1500s, the conquistadors of Spain were down in South America, in what is now Peru, looking for gold. They didn't find much gold, but they did find a plant that they took back to Europe. It was the potato. But no one in Europe would have anything to do with the plant because the botanist of the time correctly identified the plant as one from the plant family Solanaceae. This family has a large number of poisonous plants in it, such as deadly nightshade, Jimson weed, etc. Because of this relationship, it was thought that the potato was poisonous also. By the way, the sprouts and the green parts of the potato plant are poisonous. Don't eat them, or you can develop serious gastric disorders. From the family Solanaceae also comes belladonna, a valuable medicine. It is from the leaves of the belladonna plant that we get atropine. Small quantities do marvelous things for the digestive tract, but in large quantities it can kill you. All medicines are poisonous. The strange thing is that Europeans went from a condition of thinking that the potato was poisonous to one of large-scale dependence on it. Remember that the Irish experienced mass starvation as a result of the potato famine when a blight wiped out the crop repeatedly. Of course, this change of understanding took place over a long period of time. The world seems to always behave that way. We pick up some screwball idea that is based on a half-truth and let it grow into a monster that blinds us to what is really happening. By the way, the value of 1 year's crop of potatoes in the world now exceeds the value of all the gold found in the Western Hemisphere. So the Spaniards really did find gold in Peru, but it wasn't in the form they were expecting. The tomato plant came to us from Mexico, and it too suffered the same misunderstanding. Thomas Jefferson introduced the tomato to the dinner table in America, although most everyone considered it to be poisonous. If you have figured out that it also comes from the plant family Solanaceae, then go to the head of the class. Returning to the scale of policies above, suppose that the insured was 25 years old. Then the ordinary life policy would be a 75-pay plan. The payment plan could be shortened by buying a life paid up at age 65. For the same 25-year-old, this would be a 40-pay plan. It could be further shortened to a 30-pay plan or a 20-pay plan. The shorter the payment period, the better it is suited for the purposes of the infinite banking concept. Notice the triangle at the bottom of the scale of various plans. Any plan located to the left of this line is classified by the Internal Revenue Service as a Modified Endowment Contract, or MAC. These plans are not treated as life insurance by the IRS, meaning that any withdrawal or loan from the plan would be treated as a distribution and would be taxed as from any other accumulation account. Example, part is capital and part is earnings. The earnings portion is taxed as ordinary income in the year the withdrawal or loan is made. It is not a matter of earth-shaking consequences, but it can be avoided with a little bit of understanding of just what is going on. So why bother getting on the left side of the MEC line? After all, we are not attempting to accomplish all the banking needs through the device of one policy. We will need a system of many policies in order to do the complete job. This is just a description of the design for each policy to best accomplish the system. When using this type of life insurance to solve your need for banking, it is best to select a plan, the base policy, that is in the middle of the scale, such as ordinary life or life paid up at age 65, and add a paid up additions rider, PUA, to the plan. By varying the amount allocated to each portion, you can place the resultant policy at any point between the base policy and the MEC line. The whole idea is to snuggle up to the MEC line, but do not cross it. This will de-emphasize the immediate death benefit, but accentuate the banking qualities, the cash values. The irony is that doing it this way will result in providing more death benefit at the point where death will probably occur than any other plan. The base policy will pay dividends, and the PUA rider will also pay dividends. These should be used to buy additional paid-up insurance, which gives more meaning to the infinite qualities of the system. In describing this design of a policy, some people have called the process of putting a paid-up additions rider on an ordinary life policy overfunding the policy. Maybe that can help in the overall understanding, but the objective should be simply to get as much money as possible into a policy with the least amount of insurance instead of trying to put as little money in and provide the greatest amount of insurance initially. It is the exact opposite of what one thinks about when purchasing insurance. This is understandable because of the history of how the whole subject developed. It all reminds me of things such as when Christopher Columbus started his journey westward from Europe to get to the east. His destination in particular was India. When his party finally arrived at some islands in the Caribbean, they met some people they had never seen before. They called them Indians. They weren't, but the name stuck. There are probably thousands of such examples of misclassification that we run into every day, but they probably don't increase the quality of our lives. Instead, they limit our thinking and lead us to wrong conclusions. Words are powerful things. My thoughts on universal life and variable life. Universal life was invented in the early 1980s by E.F. Hutton, a stock brokerage firm that, in my opinion, knew nothing about life insurance. Remember the television commercial, "When E.F. Hutton speaks, everyone listens"? Have you heard him say anything lately? They don't exist anymore. UL was nothing more than 1-year term insurance with a side fund of an interest-bearing account. It was an attempt to unbundle the savings element and the life insurance element of a whole life policy, something that can't be done if one understands the concept of whole life insurance. This happened during a time of high interest rates, and it looked good in the early years of the policy. When I first saw the policy, I ran some illustrations, and they kept falling apart when the insured attained age 65 to 70. The cost of 1-year term became prohibitive at advanced ages and ate up the cash fund from that point forward. Therefore, I never sold one of them when I was in the business, and I surely wouldn't buy one. Next came Executive Life out in California. They made a big splash in the business and ultimately went broke. I understand that policy owners actually lost money with their policies. Does the name Michael Milken mean anything to you? He did prison time as a result of his financial shenanigans. Would you guess where he was selling all of those junk bonds? If you replied, Executive Life, then go to the head of the class. Would you like your financial future in the hands of people like that? Lastly, there came Variable Life, invented by Equitable Life Assurance Society. It was nothing more than one-year term insurance with a side fund of a mutual fund. There are more mutual funds than there are stocks. No mutual fund is any better than its manager. The great preponderance of mutual fund managers has never seen a downturn in the market until the recent one. I suggest that you read The Truth About Mutual Funds. Then read The Battle for the Soul of Capitalism by John Bogle, originator of the Vanguard Fund. These two books are vital to the understanding of what goes on in the industry. Also read The Pirates of Manhattan by Barry Dyke. Upon completion of these 3 books, you should be adequately informed to make an intelligent decision as to whether you should consider variable life. I was with Equitable Life when variable life came on the scene. I never sold one of those policies, and I would never buy one. I do not recommend its use for the infinite banking concept. The tragedy of our times is that the life companies never spent any time on understanding dividend-paying whole life insurance and teaching the buying public its characteristics. Review Part 2. Pitfalls of Human Behavior. Make sure that you fully understand all 5 of these factors. They're bedrock in building your banking business. For instance, if you can't whip Parkinson's Law, then don't bother to read further. You're wasting your time and you are doomed to slavery. 2. Understand the mortality graph that the actuaries in life insurance companies must work with. Life expectancy has increased dramatically during the last century. For banking purposes, you want the highest cost life insurance that is possible, but avoid it becoming a modified endowment contract. Minimize the death benefit and maximizing the cash value. 3. In a dividend-paying life insurance policy, you earn both guaranteed cash value, interest, and dividends, which are not guaranteed and are based upon the experience of the company. In a well-managed company, the dividends can become enormous over a long period of time.